Hello everyone, welcome back to my YouTube channel. My name is Karan and I am a chartered accountant based in Mumbai. In this lecture, we would be continuing with chapter 9 of module dealing with foreign exchange exposure and risk management. If you have not seen the first lecture, I would highly recommend you see that as the concepts would build upon the basics covered. I will put the link to the first lecture in the video description. Make sure you subscribe and hit the bell icon so that you get the notification whenever I upload a video. So let's begin with today's class. So the first topic for today is spot and forward rates. Exchange rates can either be for spot delivery or for forward delivery. The rates that we were given until now were spot rates. That is, what would be the rate applicable in case the transaction were to happen on the spot. And so spot rate can be defined as an exchange rate for delivery within two business days from the transaction date, that is T+2. Let's take an example. You went on a trip to USA and had taken a Forex card. It had $5,000 of balance and you spent $4,000 in USA. So upon returning back to India, you have $1,000 of USD balance. Because of FEMA rules and regulations, and also because you need that dollars back and to be converted into INR, you go to your bank and ask them to deactivate the Forex card and close account. The rate that will be used to convert USD to INR in that case would be the spot rate. Why? Because delivery or the transaction is happening on that spot. You are giving dollars back to bank and the bank is giving you INR. So upon documentation formalities, the INR amount would be credited to your account within 2 working days. And if you know, this is same that happens when you are buying stocks on the stock exchange as well. If you have done investments or trading in stocks, you would have seen there as well, you get the delivery of shares. That is, shares are credited to your demat account at T+2, that is transaction date plus 2 working days. And the same applies to Forex market. But it would be possible that a trader can receive foreign remittance or say wants to make a foreign payment in future, say after 2 months. Let's take an example. Mr. X is an exporter and has sold goods worth $10 lakh. He will receive the payment at the end of 2 months from today, and we are given that spot rates are $1 equals to INR 75.4 to 76.2. If we had those $10 lakh today, the rate that would be applicable to him would have been the bid rate, which is 75.4. So if Mr. X was seeing his financial position as of now, he would have thought, I have $10 lakh with me, that is 10 lakh is receivable, and the rate which would be applicable would be 75.4. And so I have INR 7.54 crores as the receivable balance. But you should know that the spot rate is irrelevant for Mr. X, because as of today, he does not have $10 lakh in his hand. And so he can't go to bank to exchange it. He will be receiving it after 2 months. And within that 2 months, anything can happen. The US Fed can either change interest rates, probably Iran or North Korea can attack USA, or there can be another wave of virus. Such events can impact the exchange rate. Suppose he didn't do anything, and because of, and also he did not know anything about risk management or hedging. And so maybe due to any reason, USD fell drastically, and after 2 months the spot rate that is quoted to him is USD 1 equals to INR 70.2 to 70.9. So the bank would have applied the rate of 70.2 as the bid rate is applicable to him, and he would have got 7.02 crores to him. Now because of this change in the values, the loss which Mr. X suffered is 52 lakh rupees, because if he had say $10 lakh on this before 2 months, so the rate that would have been applicable was 75.4. Instead, because of fluctuations, 70.2 was applicable to him, and so the total loss to him was 52 lakh. And this is huge. So many of his future plans decisions could go wrong because of this. And if this situation were to happen to him every time, Mr. X would not like to deal in foreign markets. Anytime he would sell in USD, he might get sleepless nights. What if something happens in USA or India overnight? So to overcome this situation and to ensure that there's stability, clarity and peace of mind, we have hedging tools. So what do you mean by hedging? To hedge means to protect from an adverse condition. By hedging, you make sure today itself what would be the outcome in future. And one of the currency risk hedging tools is use of forward rates. So forward rate is a rate that is decided today only for exchange of currencies that will happen in future. But you decide the rate today itself, what that rate would be. And you can think of this as similar to रोका. बस आज के आज ही फिक्स कर लिया कि कौन से रेट पे ट्रांजैक्शन होने वाला है. आगे जाके यूएसडी ऊपर गया नीचे गया कोई लेना देना नहीं. And so the agreed rate remains fixed throughout. So a forward rate is say a contract between two parties. Here you can say a customer and a banker to exchange currencies on certain specified date in future, and that would be a fixed forward rate. Coming back to the example of Mr. X, say if we had entered into a forward contract where he was quoted the rate of 1 USD equals to INR 74.6 to 75.3. So irrespective of the spot rate after 2 months, the rate that would have been applicable to Mr. X would be 74.6 rupees per dollar instead of say 70.2. Therefore, Mr. X has certainty that after 2 months he will receive 7.46 crores. And he has this certainty right from the time he enters into a forward contract that he is going to receive those 7.46 crores. Now, Mr. X would think like this is a very good way to do it, but you should know that hedging, like it eliminates the loss potential, right? But you also give up on a profit potential. Suppose the spot bid rate after 2 months turns out to be say 78 USD, 78 rupees per dollar. So in that case also, like in spite of that, Mr. X will receive 7.46 crores and not 7.8 crores. So if he wants clarity of mind and certainty, he should opt for a forward contract. And if he wants to speculate and to have say an upside potential, he should do nothing. Thus forward contracts are very important and one of the most simplest currency risk hedging tools. You should know that forward rates are not directly quoted like spot rates. Forward rates are derived from spot rates. And there are two ways in which forward rates would be mentioned in your questions. And they would be derived from spot rates. One is either through forward points, which are also known as swap points or forward margin. And second would be in percentage terms. To know how to derive the forward rates from spot rate, when say you are given forward or swap points, you should first know what is a pip. So pip stands for price interest point, and it is the smallest unit by which a currency quotation can change. So this is similar to basis points, which is used for interest rates, or tick size, which is used for stock exchange. So say for example, we are given that interest rate is 3.5% and we say it increased by 10 basis points. It means that the new rate is 3.5 plus 0.1, that is equal to 3.6%, because 1 basis point equal to 0.01%, and so 10 basis points equal to 0.1%. Now for foreign exchange we have pips, and for most currencies we have codes which run up to 4 decimal points. So the smallest change can be of 0.0001 pip, 0.001, which is equal to 1 pip. And so we are, for an example, if we have say code for Euro USD, which is say bid is 1.0213 and ask rate is 1.0219. So the difference between them is 0.0006, and so this is basically spread. What I'm doing is ask rate minus the bid rate, and so the spread is of 6 pips. Also, I would like to draw your attention towards this code and the manner in which it is mentioned. We are making use of ISO currency codes over here, And what this quote actually means is 1 euro equals to 1.0213 USD to 1.020219 USD. And this is because say I forgot to mention this in my previous lecture, was the use of ISO currency codes and symbols, and inadvertently would have used the wrong code format in say a topic of cross rates. So say we are given this quote, and another quote is this. So do you see any difference in them? Are they same or are they different? What do these quotes mean? So both of them basically mean the same thing, which is 1 pound equals to USD 1.1430 to 1.1450. And you may say, why are they written differently but have the same meaning? Now, this is because of use of currency code and a currency symbol. So if you're given three capital alphabets, and so that's a currency code. So like this. So three capital alphabets, and these are the currency code for GBP is pounds and USD is US dollars. So that's a currency code as per ISO 4217, and the currencies are say separated by slash, and there are no symbols. So that means that the former currency here GBP is the product, and the latter currency USD is the price. But if you have say currency symbols which are used, so the slash sign has to be read as per, and so because of that this would be read as US dollars per pound. So the former currency is the price and the latter currency is the product. So please make sure you remember this as it is very important. The examiner can confuse you here. So if you have currency codes which are used, the former is the product and latter is the price, whereas if currency symbol is used, the former currency is the price while the latter one is the product. Now that you know what are pips, we move on to the concept which is swap points or forward points. Swap points is basically the difference between forward rate and the spot rate. Do not confuse swap points with the concept of spread, because swap points are forward rate minus the spot rate, whereas spread is ask rate minus the bid rate. Sometimes swap points are also mentioned as forward margin, but I don't want you to think of say it as the spread of forward rates, that is the margin. Module also mentions this as silly point. You should know that it is the forward margin is same as forward points, and it is not the say the spread of the forward rates. So let's take an example on how to calculate forward rate when swap points are given. Say if we have this first example wherein $1 equals to 76.5 rupees to 76.8 rupees, and swap points which are given is 60 to 80. What is the forward rate? So first we will see what these swap points means, and how do you calculate the forward rate using them. So basically swap points are say the so in this case it would mean it is 60 to 80 pips. So how do you interpret swap points? These are basically 60 to 80 pips, and you either add them or deduct them from the last decimal point, and this has to be done in reverse order. And let me illustrate this, that would make it pretty clear. So we have this spot rate as 1 USD equals to INR 76.5 and 76.8, and we have swap points as 60 to 80. So what we do is basically write like this: $1 equals, and so for swap points we start from the last decimal and in the reverse order. Always note that swap points would be given in the same order as in for bid and ask. Now whether to add them or deduct them, that I'll tell you later, and assume that you have to add them, this one. So what you basically do is So start from the last decimal like this, and so you have forward rate would be $1 equals to rupees 77.1 to 77.6. And so what you're basically doing is starting from the last decimal and then adding it. Let's take another example. uh, Say we have euro 1 equals to USD 1.0820 to 1.0890, and the swap points are given as 55 to 65. So what you do in this case is say write like this. So 1 euro equals to USD 1.0820, 1.0890, and then we have swap points. So what we basically do is start from the last decimal point, and then suppose we are said to add this as well. So we are adding this right from the last decimal. You start writing it in reverse order and then add it. So we'll have So we'll have 1 euro equals to dollar 1.0875 to 1.0955 as the forward rate, given this spot rate and the swap points. Let's take another example, the last one, so that we are pretty clear as to how this how spot rates, and if you are given with spot rate and swap points, you can derive the forward rates. So we write again like this. So this is SGD, and so now in this case, if we are given say swap points are 30 and 20, and we are said to that we need to reduce them. So if we reduce them, always start from the last decimal. And as I said, whatever, like whether you need to add or deduct, always the swap points that would be given would be first would be the bid rate or related swap point, and the next would be the ask rate related swap point. So we'll have 0.7530 and 0.7550 as the swap point. So I'm sure this makes sense, and now we'll look as to how you need to decide on what basis whether you add the swap points or you deduct them. In the example still now, I mentioned whether you had to add the swap points or deduct them. But how would you identify what needs to be done? So the question can mention two types of information. The first is that the question will directly mention whether the product currency is at premium or discount in forward market. If it is mentioned that product currency is at premium in forward, means that forward rate is higher than the spot rate, and thus we add the swap points. But if it is mentioned that the product currency is at discount in forward, means that we need to deduct the swap points. In other cases, the question will not mention anything about premium or discount. So in that case, you need to observe how the swap points are given, whether they are given in ascending order or in descending order. If the swap points are given in ascending order, we add them. And if they are given in descending order, we deduct the swap points from the spot rate in order to arrive at the forward rate. Of course, this is subject to anything in contrary mentioned in the question. The logic for this is as follows. Consider the case of swap points in ascending order, And we take our example wherein we had $1 equals to INR 76.5 to 76.8. So if we add, we got $1 equals to INR 77.1 to 77.6. So what is happening is the bank's cost of buying $1 is going to increase by 60 paisa. And so to make sure that the margin returns, that is the spread, remains same or increases, it would increase the selling price by same or higher amount. So here it is increasing the price by 80 paisa and the spread increases from 30 paisa to 50 paisa. This sounds logical, but what if we reduce this swap points? So if we reduce, we would have got $1 equals to 75.9 to 76 rupees. And this means that the cost of buying reduces by 60 paisa, and at that time the bank reduces its selling price by 80 paisa. So the spread reduced from 30 paisa to 10 paisa. Why would a bank do that? Why reduce the margin? And so this doesn't make sense, and accordingly, when swap points are in ascending order, it is presumed that forward rate is in premium, and so you add the swap points. Similarly, you can think of swap points in descending order. So let's take the example wherein we have the same spot rates and the swap points that are given are 30 and 25. And if we reduce them, what we get is the forward rate as 76.2 to 76.55. This means that the cost of buying for bank is reducing by 30 paisa, and at that time it reduces its selling price by 25 paisa. So the spread ultimately increases from say 30 paisa to 35 paisa. And this, as I had said earlier, bank always wins, and so will always try to increase its spread. So this makes a logical sense because this swap points are in descending order and we reduce them. But what if we add? We would have got the rate in forward as 76.8 to 77.05, wherein you ultimately reduced your spread from 30 paisa down to 25 paisa. And so we don't want that. So ultimately, when the swap points are given in descending order, we presume that the forward rate is at discount, and thus we deduct. I hope this makes sense, and it's an easy way to remember. If it's in ascending order, it's add A and A, and if it's in descending order, then we deduct D and D. So now that we know that swap points, what are swap points and whether we add them or deduct them, you should also know that the forward rates are generally interbank rates and they are given for standardized dates, which is generally the end of month. So as an example, the spot rate can be say one Singapore dollar is 47.0725 to 47.0745 INR, and notice how the quote is given. It is different. It is given in a different manner than what we are accustomed to see. And the premium which is given over here, the premium swap points can be quoted like this, which means this basically means that the swap points for the month of July end, and the spot rate is given for 30th June. So the swap points for 31st of July are 133 to 140, whereas the premium swap points for August, that is 31st of August, is 145 to 160 pips, and similarly same for September as well. But not every customer will want say a forward rate for end of the month. It can be for any day. It can be either for say 22nd July, 5th August, and so on. Say we want a forward rate for 11th of August. So broken period forward rates is basically finding the forward rate for a date which is between two standardized dates. So here 11th of August is between two standardized dates. So here 31st July and 31st of August. So 11th August falls between them, and we want to find the forward rate for this date. What we would be basically doing is finding the broken period forward rate. And to find the broken period forward rate, what we basically do is interpolation. So I'll draw a timeline to explain this. So we draw a timeline and say we have the spot rate is given as of 30th June. We have say 31st of July, and then after that we have 31st of August. In between that we have 11th of August, and we want to find the rate for that. So what they have given is from the spot till 31st of July, we have the premium swap points as 133 to 140, and from 30th of June till 31st of August, the swap points are 145 to 160. Now we need to find what is the rate till 31st till 11th of August. What we basically do in this case is say till July we know that the premium is 133 pips to 140 pips, but for total period from 30th June till 31st of August we have 145 to 160 pips. So in this what we basically are doing is, so for bid pips, bid premium swap points would basically be 133. Then so you are adding till 11th of August. This is the difference between the swap points from July to August, but this is for entire period of say 31 days of August. We don't want them, we need only for 11 days. So on solving you would get 133 plus, if you solve this on calculator you would get about 4, and so this comes to 137. This is for bid. If we do same for ask, that would be starting with say 140 plus, now the difference between July and August is 140 to 160. So this difference of say 20 pips is for say a period of 31 days, but you only need it for a period of 11 days. So that's why you are doing the interpolation, and so we have the difference which is for the entire period of August, but that is for 31 days. You need it for 11 days. On solving you should get 7, right? And that comes to 147. So basically we have found out what are the swap points for the period starting from 30th June till the date of 11th of August. Now we can basically write the swap points from the reverse order and then solve it. So the spot that we were given was SGD1 equals to rupees 47.0725, 47.0745. For bid we had 137 pips as the premium, and for ask we have 147, and when we solve we should get 47.0862, 47.0892. I hope this is clear as to how you find a broken period forward rate for say any date which is in between. Let's try another example. First, the solution for this is the same as which I had shown you, and the forward rate for 11th August is 47.0862 to 47.0892. So let's solve for 21st of September, and uh, we can start by drawing a timeline same as we did for 11th of August. So right, for now we can directly take August and September, and we have the date as here. So what we are given is this and this. What we need to find is from here to here. So the rates that are given for is 145/160, and for June to September what we are given is 155 to 175. So we can solve by interpolation, and notice that we didn't consider July because we have been given the actual forward rates till forward swap points till August. So this gives us a more better answer rather than taking again July, then August, and then going to 21st of September. So for bid we would have 145 plus the difference, so 155 minus 145. Notice this is the difference for the dates from August till September. So, and that is for 30 days. We require it for 21 days. So it would be 145 plus 7, and that would come to 152. For ask, we would start with 160 because that's the swap points till August 31st. Add the difference, so 175 minus 160. This is for 30 days, we require for 21 days, and on solving we should get 11, and so the swap points is 171. Now we again take the spot rate that was given, 47.0725 to 47.0745. we add the swap points, 152, 171, because the question clearly says it's premium, so that's why we are adding, and also it's in ascending order. On solving we should get 47.0877 and 47.0916. So here's the solution for the forward rates for 21st of September. I hope this is clear. The same one, and we have the forward rates. So moving forward, we have the appreciation and depreciation of currency. So another way to arrive at forward rates, as I had mentioned earlier, is through percentage of premium or discount. So when a price of a product currency is going to increase in future, here the words again, price of the product currency. So the product currency is increasing, so the forward is at premium over the spot, and that is said to be appreciation of the product currency. Similarly, when the price of product currency is going to decrease in future, so that's the forward is at discount over the spot, and that is said to be depreciation of the product currency. Let's take a simple example wherein we have spot rate is $1 equal to 50 rupees, and 3MFR, which means 3 months forward rate, is 55. We can clearly see that the dollar price, the price of dollar, which is the product, is increasing, and so it can be said that dollar is appreciating against the rupee. Now we need to find what is the percentage of appreciation because it is increasing on an annualized basis. So what we do is basically the change, that is 55 to 50 upon original amount, which is 50, into 100 to get it into percentage terms, and we do 12 by 3. This is because we need annualized number. So this difference of 50 to 55 occurred within a period of 3 months. So what would it have been over a period of 12 months? So that's why you divide by 12 and divide by 3, which is the period of months for which you need to annualize. And upon solving, you should get 40 percentage per annum. And this is the appreciation. I have taken a one-way quote over here because even if you have two-way quote, anyways you need to do the calculation separately for bid rate and the ask rate. And so nothing changes major as such. Let's take an example wherein we have the 3-month FR as 48. Now you can clearly see that the price of dollar is decreasing, and so it can be said that dollar is depreciating against the rupee, and the percentage of depreciation on an annualized basis would be the same. So it is change, that is from 50 it goes down to 48 upon original amount, that is 50 into 100 to get it into percentage terms, and 12 by 3 is because you need an annualized figure, which gives us 16 percentage per annum. Notice as I am writing depreciation, that's why I am ignoring the negative sign that would have come because when you solve this numbers, but as we are directly writing it's a depreciation, so it can be a positive number. Now based on both the examples, you can clearly find out what is the formula that we are using. So the percentage of appreciation or depreciation of product currency on an annualized basis is basically the change. So forward rate minus the spot rate upon original, that is the spot rate, into 100 into 12 by m. So this is for annualized number, and this is basically this is a basic general formula for finding a percentage change. So change upon original into 100. Read the question carefully, whether they have given percentage for the period or an annualized percentage, because you don't want to make a silly error. The formula will not have 12 by m if the question says, say for example, find the percentage dollar appreciation during that period. So you don't need an annualized number, and that's why you won't have 12 by m as the figures in the formula. Also, if you are given percentage change and the spot rate, you can plug in the numbers in this formula and get the forward rate. But be very careful that this formula is for the product currency. Read the question carefully to know which currency are they talking about, product currency or the price currency. If they say rupee is depreciating by 10%, you can't use this formula because rupee is the price of this quote, and this formula is only for the product currency, and you are given the change in the price currency. So don't make an error, read the question carefully and then apply the formula. So if we want to find what is the percentage of appreciation or depreciation for a price currency, let's get back to our original example wherein we had the dollar which was appreciating by 40 percentage per annum. Now as dollar is appreciating, rupee is depreciating, but it would be incorrect to state that rupee is also depreciating by 40%. So how do we find what is the percentage change in the price currency, which is rupee in this case? So we have two methods for it. First is to convert the direct quote to indirect quote and then use the formula. So what we would be basically doing is make rupee as the product and then make use of the formula. So this is basically taking the reciprocal because it is a one-way quote, and you must know this by now. And the percentage of depreciation of rupee on an annualized terms would be the change upon the original number into 100 into 12 by 3, to get an annualized number, which would be 36.36% per annum. Now, what you want to do, what if you don't want to change the direct quote into indirect quote, and because that was a simple one-way quote. What if you had a two-way quote? It just makes a bit of your life difficult, and also it is a bit time consuming as well. So in the second method, you don't change the product of the quote, but you make use of a modified version of the formula, which is this one. This is basically forward rate minus the spot rate upon forward rate. Notice it is not SR, it is not spot rate, it is the forward rate into 100 into 12 by M. So everything remains the same, only changes instead of spot rate, you have the forward rate. You may ask why forward rate is used in the denominator. Well, I'll show you how this formula got derived, and we basically go back to our method 1 to know how this formula was derived. So what you're basically doing over here is 1 by the forward rate, because 55 was the forward rate wherein the dollar was the product, minus 1 by spot rate upon 1 by the spot rate. I'll leave into 100 into 12 by 3 as it is, because it would remain same pretty much afterwards as well. So this becomes spot rate into 1 by FR minus 1 by SR, which is SR by FR minus 1 . And this was what we were basically using as well. So forward rate becomes the denominator in this case. So now when we make use of the formula, what we get is so forward rate 55 minus 50 upon 55. So this is the forward rate into 100 into 12 by 3, and we should get the same answer of 36.36% per annum. So depending on the question and which method suits you the best, you can choose. Personally, I would prefer method 1, because yes, it is a long method, but you only have to remember one formula, which is the ordinary formula of any percentage change. Also, I always prefer making that currency as the product for which question has given percentage change directly. That is basically saying जिसका भी directly percentage दिया हो उसको product बनाने का. So if they say that dollar appreciates by 10%, dollar should be product of the quote. Also note that always percentage appreciation of one currency would be greater than percentage depreciation of another currency. And to make you understand this, I'll take a simple example. If we have 100 and if you add 5, which would give you 105, which is basically a 5% appreciation. But from 105, if you go down to 100, which would be depreciation of the same amount of 5, but 5 upon 105 would give an amount which would be less than 5%. I hope you got how to derive the forward rate from spot rate. I hope you would have understood the concepts till now. That's it for this lecture. If you have any doubts, comments, suggestions, please post it in the comment section below. Also, don't forget to like, share and subscribe. I will see you next time. Until then, goodbye. Take care.